Imagine, if you will, spending millions of dollars.
Oh, easily.
Yet tens of thousands of man-hours, just, tearing your hair out in these endless meetings over a document that is mathematically guaranteed to be entirely wrong.
Right. Like the very second it gets printed.
Exactly. The second it is printed, it's outdated. And that is, well, that's the paradox of the corporate budget.
It really is.
It is universally dreaded. It's completely inaccurate. And yet organizations would instantly collapse without it.
Yeah, it's this incredible contradiction, right? We hold up these massive financial plans as like absolute gospel.
Right.
Even though everyone sitting in that room knows full well that the future just refuses to cooperate with a spreadsheet.
So true. Well, welcome to the deep dive, everyone.
Glad to be here.
So whether you are running a massive division, prepping for some high-stakes leadership summit, or you're just a learner who is, endlessly fascinated by how giant entities attempt to peer into the unpredictable void of the future.
Which is a fun place to look.
It really is. Today, we are pulling apart the mechanics of business planning and budgeting. We're basing this on an excerpt from Chapter 12, Business Planning and the Budget.
A great piece of source material.
Yeah, really insightful stuff. And our mission today is to sort of rescue this concept of budgeting and planning from its dry, dreaded corporate stereotype.
Because it really gets a bad rap.
It does. Because when you actually look under the hood, budgeting isn't some dry accounting exercise. I mean, it is a ruthless psychological battle plan.
Absolutely. The real underlying engine of a budget, it isn't math at all.
Right.
It's human behavior. It's about institutional survival.
Okay, so let's unpack this. Let's start with the foundation, the actual blueprint of planning.
Right. What is it and why do we do it?
Exactly. The fundamental premise we are looking at in the text is that planning basically organizes management knowledge to mobilize resources toward goals.
Right.
So you do all this research, right? You look into markets, technology, the economy, the competition, HR, organizational development. But, I mean, why go through this agonizing process when the ground is just constantly shifting underneath you?
Well, what's fascinating here is that the alternative is just reacting blindly to your environment.
Which is terrifying.
Yeah, it's a terrible strategy.
Yeah.
A really interesting premise established early on in the source is the explicit acknowledgement that the future is not an extension of the past.
Which, sounds obvious.
Right.
But I feel like companies act like the future is an extension of the past all the time.
Oh, constantly.
They just take last year's revenue, add like 5%, and call it a strategy.
They do it because it's comfortable.
Yeah.
But I mean, with technological acceleration, global competition encroaching on almost every single industry.
Not to mention demographics changing.
Exactly. Shifting demographics, regulations changing, assuming a linear progression is basically a death sentence.
Yeah.
That's why rigorous self-examination tools have to be embedded in the process. Things like the classic SWOT analysis.
Oh, SWOT. Strengths, weaknesses, opportunities, and threats.
Right, breaking all that down.
But, okay, let's be real about how SWOT analyses actually play out in a lot of corporate environments.
Oh, sure.
Because usually it's just a bunch of executives sitting in a room weaponizing the strength column to justify some vanity project they already want to do.
Yeah, working backwards from their conclusion.
Right. While completely glossing over the weaknesses. It's like a corporate health checkup before running a marathon.
Okay, I like that analogy.
But the patient is actively lying to the doctor because they don't want to hear that they have a bad knee. You need to know about the bad knee before you map out the route.
That is a brilliant way to put it, and that is exactly the trap. A proper analysis isn't meant to validate management's existing biases.
Right.
And crucially, it's not meant to eliminate risk.
Wait, really? Because I feel like people think the whole point of corporate planning is risk avoidance.
I know, but it isn't. The actual goal is risk targeting.
Okay, risk targeting.
You are trying to ensure that your organization is taking the right risks for the right reasons, and that those specific calculated risks are actually adequately funded.
Okay. And doing that requires distinct battlegrounds of planning, because we aren't just talking about planning as this one monolith.
No, the tech breaks it down into 5 types.
Right.
Doesn't.
You have strategic planning, which is the big existential question, like what business are we actually in?
Yes.
Then marketing, which focuses on pricing, service, and why the customer should even care.
Exactly.
Sales looks at distribution and awareness. Operations examines the supply chain and tech. And then financial planning figures out the cash flow and debt.
Right, those are the 5.
But how do these massive competing departments interact without just completely tearing the company apart over resources?
Well, they often will tear a company apart if the goals aren't structured correctly.
Fair enough.
For these departments to align, the source notes that their goals must meet very specific criteria. They have to be quantifiable.
Meaning they need to be time-related, measurable, attainable, simple, and realistic.
Exactly. For example, if marketing's goal is simply to increase brand awareness,
Which you hear all the time.
you do, but that is functionally useless.
Right.
It's way too vague to budget for.
Right.
But if the goal is acquire 50,000 new qualified leads by Q3 to support the sales pipeline,
Oh, that's totally different.
right now you have a structural load-bearing beam that operations and finance can actually build a plan around.
Okay, so we have this perfectly logical framework. We assess the risks, we create measurable goals, we align the departments.
Sounds easy on paper.
Right, but this brings us to the friction. Here's where it gets really interesting. Because if this blueprint is so crucial for survival, why do managers treat planning like they're getting a root canal?
Yeah, they hate it.
This is where our source material pivots into a catalog of human flaws.
Yeah.
And, I mean, it is fascinating.
The psychological aspect is where things get incredibly treacherous. Humans are just inherently flawed prognosticators.
We're terrible at it.
We really are. Take optimism, for example.
Okay.
The text highlights this deeply ingrained, almost blind belief among managers that performance will just organically improve next quarter.
Right, even without any fundamental changes to their operations or strategy.
Yes, things will just get better.
It's almost like a survival mechanism so they don't panic on a daily basis.
Probably.
But the flaw that really caught my eye here is the oversimplification of the environment. Specifically, this concept of point forecasting.
And point forecasting.
Yeah.
That is one of the most dangerous psychological crutches in business.
Right. Explain that for a second.
Well, it's when a manager declares, we are going to sell exactly 10,000 units next year. Not a range of possibilities, mind you, an exact specific number.
Because human beings absolutely despise ambiguity.
We hate it.
I mean, if a manager stands up in front of a board of directors and says, well, based on these variables, we will sell somewhere between 8 and 12,000 units.
They sound unsure.
Exactly. They sound weak. But giving a single hard number projects confidence.
But it projects a completely false confidence.
Right.
By ignoring ambiguity, you aren't planning for alternative scenarios. You are just placing this massive, rigid bet on one very specific version of the future.
And when the environment inevitably doesn't cooperate...
The entire plan shatters.
Oh.
Because there's no elasticity built into it.
But I have to push back here.
Okay, go for it.
It sounds like people are terrified of leaving a paper trail of their predictions. I mean, why wouldn't managers point forecasts? People resist planning because they know it creates an ironclad record of accountability.
Yes, exactly.
If I know my budget forecast is going to be used as a club to beat me with at the end of the year, I'm going to game the system.
Of course you are.
I'm going to hide in my daily busy work, defining myself by what I do every day, rather than committing to a strategic plan that might literally get me fired. How do you get a team to commit to a plan if they're paralyzed by the fear of being wrong?
This raises an important question, and it's the exact crux of the management challenge the text dissects. How do you extract an honest, risk-taking forecast from an employee who knows their annual compensation depends on it?
It seems impossible.
The solution required, according to the source, is the creation of what's called a non-punitive environment.
Okay, come on.
I know.
A non-punitive environment in cutthroat corporate America. I mean, how do you actually hold a vice president accountable for missing a massive revenue target without it feeling like a punishment? That feels like a total oxymoron.
I get it.
You either punish failure or you accept mediocrity, don't you?
It sounds like a paradox, but it requires a highly sophisticated organizational culture.
Okay.
A non-punitive environment doesn't mean there are zero consequences for incompetence or laziness.
Right, you still have to do your job.
Exactly. What it means is that there are no excessive reprisals for taking a normal, well-reasoned business risk that happens to fail due to external factors.
Oh, I see.
Look at it this way. If a manager makes a sound bet based on really solid research, and then an unforeseeable macroeconomic shock ruins the outcome, firing that manager just ensures that no one in your entire company will ever take a risk again.
They'll just play it incredibly safe.
Always. You do have to tie performance appraisal and compensation to accomplishment, yes, But you have to balance that by evaluating the quality of the decision-making process itself, not just the raw outcome.
It's a really delicate psychological balancing act.
Extremely delicate.
So you have human optimism blinding people, the fear of accountability paralyzing them, and the hatred of ambiguity forcing them into these rigid point forecasts.
A real mess.
How does a giant company actually corral all this chaos without every day devolving into a philosophical debate?
By establishing rigid guardrails.
Guardrails.
Yeah, organizations create planning guidelines and policies to eliminate the need to make the same decisions repeatedly.
It's essentially a cure for decision fatigue.
Exactly.
Because if the executive team have to evaluate every single shiny new object or, potential market opportunity from scratch,
They'd never sleep.
they will completely exhaust their management bandwidth. So you build this structural filter. It's like the bumpers in a bowling alley.
Oh, I love that.
They don't bowl the strike for you, but they keep you out of the gutter when you get distracted.
If we connect this to the bigger picture, a good policy basically acts as an automated no.
Right.
For instance, the text gives an example where a corporate development guideline might dictate that the company will not enter any market with a growth rate of less than 15%.
So if a manager comes into a meeting incredibly passionate about this new product line, but the underlying market is only growing at, say, 8%, the meeting is over before it even begins.
It's a non-starter.
The passion is irrelevant because the structural guardrail keeps the company focused. It completely removes the internal politics from the equation.
Exactly. Another classic example from the source is a financial policy requiring a 20% return on equity for any new investment.
Okay, break that down for us.
Return on equity simply means for every dollar of shareholder money invested in a project, that project absolutely must generate 20 cents of profit.
Right.
Establishing that rule instantly filters out the vanity projects. Or they might have a rule about reinvesting at least 60% of net income.
Which makes sense. And these guardrails dictate how the actual budget is built.
They do.
Which leads to this fascinating dynamic in the text, the idea that a budget absolutely must be built bottom up.
Yes, very important.
The finance department does not create the budget. The individual department heads do.
Because think about it. If a budget is handed down from an ivory tower of accountants,
the operational managers will immediately reject it.
Instantly. They will say, those numbers are impossible, I had no say in this, and I'm not accountable for it.
Right.
Bottom-up budgeting forces interdepartmental cooperation. It is fundamentally a management challenge designed to secure buy-in, just disguised as an accounting exercise.
So the budget department is just there to coordinate and advise.
They're just the facilitators, yeah.
But, okay, when these departments are building this bottom-up budget, there is an admission in the underlying research that honestly shocked me.
What was it?
It explicitly states, precision does not count.
Ah, yes.
A financial planning philosophy openly admitting that mathematical precision doesn't matter.
It is a profound acknowledgement of reality, though.
Is it?
Yeah. Budgets and forecasts are just estimates built on assumptions.
Right?
Creating unachievable, hyper-precise theoretical models is a complete waste of time.
Yeah.
What actually matters is that you have developed realistic fallback plans.
Like best case and worst case scenarios.
Exactly.
So wait, the document itself, the actual spreadsheet with all the numbers that everyone agonized over is basically disposable once it's finished.
Pretty much, yeah. The ultimate takeaway from the source is that every excellent plan is almost out of date by the time it's being used.
That's wild.
The true asset you walk away with isn't the document. The value of the planning process is the thinking, the research, and the communication that it fosters. You haven't predicted the future, but you've developed the mental flexibility to actually adapt to it.
Okay, let's take all this psychological theory and see how it plays out where the rubber actually meets the road.
Let's do it.
I want to look at the two biggest engines of any company, sales and operations.
Oh, this is the best part.
Because applying these philosophies to sales planning has to be the most agonizing part of the entire process.
It really is. It's a constant, hilarious tug-of-war.
So what does this all mean for the sales rep?
Well, salespeople, by their very nature and profession, have to be aggressively optimistic.
Right. To do their jobs well, they have to wake up every day believing they can close any deal and conquer any market.
Exactly. They know the market best. But the moment management sits them down to forecast their quota for the upcoming year,
suddenly they transform into doomsday preppers.
it's amazing.
The market is terrible, competitors are everywhere, the customers have no money, I can't possibly sell more than I did last year.
Right. They intentionally sandbag or, lowball their forecasts so they can easily clear a low bar.
And hit their bonus accelerator.
Exactly. And management knows they are doing this.
Of course.
So arriving at a consensus forecast is this really complex negotiation between inherent optimism, strategic pessimism, and actual market reality.
And you can't just look internally, right? You have to factor in external shifts.
Things nobody controls,
Mhm.
like watching trade shows to see competitors' strategic identity or macroeconomic shifts.
Yeah. And there is a perfect case study in the text of why point forecasting destroys companies when it comes to those external factors.
It's a currency shift.
Right. The massive currency shift in the 2014 to 2015 period.
Yeah.
The US dollar suddenly surged in strength. Now, as a layperson, you hear strong dollar and you automatically think, well, that's a universal positive.
And it is if you are in the business of importing.
Right.
If you are an American company buying raw materials or components from overseas, the strong dollar means those materials just became 10 to 15% cheaper overnight.
Wow.
Your profit margins just explode without you doing a single thing.
But if you are a US manufacturer exporting your products to Europe,
It is a catastrophe.
because of the currency exchange rate, your products just became 10 to 15% more expensive for European buyers.
Exactly.
You didn't change your product, you didn't raise your prices, but you instantly lost your competitive edge.
And nobody doing their strategic planning in 2012 could have predicted that specific macroeconomic swing with any precision.
No way.
You would have had to be literally clairvoyant.
Right.
This is exactly why the text insists that relying on a single rigid forecast is dangerous, and why having flexible fallback plans and alternative environments is the only way an exporter could survive that kind of shock.
Which really dictates everything that happens next in operations planning.
Oh, absolutely.
Because once sales throws their best educated guess over the wall, operations has to figure out how to physically build the product or deliver the service without just burning through the company's cash.
And this brings in the concept of efficiency, right?
Yeah.
Managing resources, specifically things like work-in-process inventory.
Right. Explain work-in-process inventory.
It's exactly what it sounds like. Half-built products or services that are mid-delivery.
Okay.
But financially speaking, it is just money sitting on the factory floor doing absolutely nothing. It is just tying up your cash.
Right. And by using technology to tightly link customer orders directly to machine schedules and workforce shifts, you can reduce that idle inventory.
Exactly. You accelerate the billing process.
Meaning you get cash in the door way faster.
Yes. The text points out that these technological investments in scheduling usually pay for themselves in less than a year.
That's incredible.
And this granular level of planning also dictates your workforce strategy.
Oh, great.
For instance, depending on the changeover costs, the time and money it takes to start and stop your machinery.
Yeah.
It might actually be mathematically cheaper to run 4 10-hour shifts and pay a little overtime than to run 5 standard 8-hour days.
Because you are maximizing the assets you already have.
Exactly.
And it also drives the logic behind what a company decides to outsource.
Right. Looking at where the value is.
You look at your operations and ask, where are we actually adding value? If a process isn't your core competency, if it's just draining resources, you outsource it.
Yep. That frees up your assets, your cash, and your people for value-added work.
And notice the sequence here. We're talking about capital allocation at the very end.
Yes. The capital budget is prepared last for a very good reason.
Why is that?
You cannot possibly know what capital you need to invest in new equipment or facilities until you have done the exhausting work of figuring out the SWOT, the sales consensus, the operational scheduling, and those fallback scenarios.
You have to do the homework first.
Exactly. It all builds up to that final step.
Which completely reframes the entire concept of budgeting for me.
Really?
Yeah. I mean, we started off talking about the dread of spreadsheets, stale coffee, and administrative busy work.
Right, the root canal.
Exactly. But what we've actually unpacked is an intense psychological battle plan. It's about forcing a company out of its comfort zone, dragging its inherent human biases into the light, and building a flexible baseline for reality.
Because when the unpredictable inevitably happens,
And it always does.
when the currency swings dramatically, or a competitor disrupts the market out of nowhere, the company isn't paralyzed.
Right.
They have already done the mental heavy lifting. They have the institutional muscle to pivot.
We promised you at the top that this was essential knowledge, and hopefully you now see the corporate budget not as a mathematical straitjacket, but as a really dynamic survival mechanism.
Absolutely. But, I want to leave you with something we haven't touched on yet.
Oh, What's that?
A bit of a thought experiment to mull over as you think about the future of planning.
Okay, let's hear it.
We've spent this entire time dissecting the flaws of human forecasting, right? Our blind optimism, our fear of ambiguity, our tendency to sandbag quotas.
Yeah, all are very human flaws.
But imagine a scenario in the near future where artificial intelligence becomes so advanced that it actually can perfectly predict macroeconomic shifts, consumer behavior, and currency fluctuations.
Oh, wow. Okay.
If the technology eventually provides a flawless, perfectly accurate point forecast,
Does human business planning become completely obsolete?
exactly.
Mm.
Or does the psychological alignment of the team, the shared struggle of getting everyone to believe in and execute the plan, somehow become even more important when the machine is doing all the math?
Now, that is a thought experiment that flips everything we just talked about entirely on its head.
The text notes that the process of planning is where the real value lies, right?
Mhm.
So think about your own life or career trajectory. Are you stubbornly clinging to a rigid point forecast of where you want to end up?
Or are you embracing the process of planning for a range of outcomes? A perfect crystal ball might not actually solve the human problem after all.
Something to think about.
Truly. Well, thank you for joining us on this deep dive. Keep questioning the numbers, and we will catch you next time.